recording the backup. So just before we start speaking,
Recording in progress.
before I start sharing my screen and everything, I hear that you guys had questions from the previous class. So what I'll do in this session is we're gonna go for an hour and a half. That's what we planned, G and I. So essentially, what's going to be happening during that hour and a half is I'm going to take questions for at least 10 to 20 minutes, and yeah, we're going to move on off of that afterwards. Today I'm speaking about the pattern. So the last time we came here I spoke about the market condition. Today I'm speaking about the pattern, and what the pattern is, it's simply level count. It's the concept, so it should tie things together for everyone, and things should start making sense by the end of today's lesson. So without wasting more time, let me start sharing my screen, and you guys can simply just start addressing your questions. Oh, Gia, I'm not set up as a host, so I can't necessarily share my screen. Are we a go?
Yep, you should be good now.
Oh yeah. Alrighty. So can everyone see my screen? Should be seeing a launch pad or something.
Yeah, we can see.
Alright, let me just load up MetaTrader. Alright, so what questions did you guys have with regards to the last or the previous class? I know I went off, God bless South Africa, load shedding. So I'd really like to know what questions did you guys want to address. Can I take the first question, please?
Hi, this is Robin. I was wondering if you can go over the ebb and flow of the M and the W and the candlesticks. Like, if you could just clear that up. I mean, I feel like I can identify it when I look at it, but I would love if you could just go over that. And in addition, what are you looking for in sense of you're buying? I'm assuming you're buying in the W and you're selling in the in the M.
All right. Okay, that's a good question. It's a wonderful question. There are precisely 4 price points that make up a candlestick or a day. Namely, there is an open, a high, a low, and a close. That would be in a downtrend. In an uptrend, there would be an open, a low, a high, and then a close. I'll draw a diagram, but for now, let me just talk. What this means essentially is...
In progress.
Yes. What this means essentially is that when market makers deliver price... I don't know, there's an echo on my side. Do you guys hear an echo? Let me just try fixing it up.
We did hear echo, but I don't hear it now.
Alrighty. Can I just grab my PC charger? My battery might die in a moment. Alright, excuse me about that. Just a moment. Okay, so essentially what this means is for you to trade price action, you need to identify the high. This is for when you are selling, and the low. This is for when you are buying. Thank you for excusing me for just a moment there. Okay, so let me give you an example from the past 3 days with annotations. Let me just use Zoom annotations. I think it should be easier that way. I usually take a screenshot on the laptop and I go ahead. Can you guys see the annotations, or should I make a bigger fonts? Let me clear all annotations. All right. So essentially at the end or at the beginning of a trading day, there is a consolidation to start the day. This could be at the end of the day, at the end of a session, or the beginning of a new session. For example, here it was the end of the London session and the beginning of the New York session. And this is the one I posted on the Discord. So when price comes out of a consolidation, primarily the first move, or ideally the first move coming out of that consolidation, is a false move. When you are looking for a sell, price will open, remain in a consolidation, give us the false move. You identify the false move by 3 pulses. 1, 2, 3 pulses to the high. This move that is comprised of these 3 individual pushes usually takes like 2 to 4 hours to form up. All right, this sometimes it can be 30 minutes, 45 minutes, 3 candles, 15, 30, 45, 3 big candles. However, this move is comprised of 3 pushes. It can be 3 individual candles, or it can be 3 individual pushes, 3 pulses, a group of candles. This will form your high of the day. So this would be your opening price. This would be your high. So OH. When you have an O and an H, you're looking for an L and a C. Open, high. This is where you look to place your sell trades. To answer your question now, where do I buy or sell? This would be your sell setup. Your sell setup is good on the second leg of an M. What do I mean the second leg? This would be the first leg, and this would be the second leg. So this is where you sell. When the rest of the retail world is looking to purchase a trend continuation up in here and set a stop loss beneath here, buy the dips in an uptrend, you're looking to place your sell up in here. All right? And you're looking for that, like this. Let me use an eraser to remove this annotation to limit confusion. So this is where you would sell. You're looking for the trend. The trend is a downtrend in this case. After that trend, which is usually comprised of 6 to 8 hours of price action. By the way, when price moves away from the high here, this is the no trade zone. What do I mean the no trade zone? That term simply means do not press the trading buttons. Do not try selling in here because you know that it's going to continue moving down. It's a gamble. It's a 50-50 gamble. What do I mean it's a 50-50 gamble? It only offers you a 50% proposition. it only offers you a 50% proposition. The high probability setup is selling at the second leg of that M formation. Let me identify it for you on the charts. So this would be the stop hands. Okay, let me use the pen. This would be the
Can
stop.
I jump in with a quick question on that one?
Yeah.
Would that look like a gap down?
A gap down where? Yes, down here.
No, I'm saying like when you're going from your high to your low, when you're saying that the retail world is going to jump in, would that look like it's gapping down? So you see where,
This area here.
yeah, like there'll be like a gap in between
Okay.
the candlesticks, and they'll like jump right down to a red candlestick at the bottom.
Okay, buddy. That's also a good question. That can happen. Price can absolutely form up an M and then gap from up here all the way down here, depending on what is happening. Let's say, for instance, with the NASDAQ, there's something like CPI, a news release, CPI, or maybe non-farm payroll. That can, in fact, happen. There would be a certain reason that the market maker will use to conceal the reason for gapping the markets. Just like here. Though this one is a relatively smaller gap, but there is a certain reason as to why the market maker gapped price over there. And I'll explain it right now. All right? So essentially what happens is price at this price point offers you a high probability sell setup. The trend, when the second leg shifts downwards and it there's this candle called the shift candle. Let me remove all annotations. So this was the first leg of the M. This is the second leg of the M. The second leg can go over the first leg so long as it ends as railroad tracks, simply one candle up, one candle down. Or people can call this a bearish engulfing. Or it can close on a hammer. A hammer would simply be a hammer close candle like this up in here, away from the high. All right. Does someone have a question? Okay, I think just open the chat. All right, doesn't seem like these are questions.
I think he was just on mute.
Oh, okay.
Whoever the phone number is, can you mute?
Yeah, let me see who that is. Yeah, I know some of the people aren't here too that had some questions. I don't see them here yet.
Right.
But so far so good. We're good.
No problem. The following day, this very pattern prevails. Price comes out of a Asian London consolidation. Okay, so this is the Asian session in here. This is the London session in here. And price was consolidating throughout both sessions. And then from the beginning of the New York session all the way till midday New York, we got this price action comprised of what we call a stop hands. I don't know, I posted this on my WhatsApp. Let me check. I don't think I'll be able to do that with the annotations in me. Yeah. Jeez, man. Okay. I think this is where I should go. I posted this on my status update. Here it is. And I posted this as well on the Discord. That price will come out of a consolidation. okay? After the consolidation, there will be a stop
We
hunt.
don't see a screen.
You don't see a screen. Okay, maybe it's because I'm on WhatsApp. Maybe Zoom is considering WhatsApp as okay. Let me share
You
again.
might have to do a new
Alright.
share.
Okay, can you guys see now? You should be able to see.
Yeah, we see you.
Yeah.
Alright, so price essentially comes out of consolidation. It gives us a stop hunt, and that's where we enter our trades. And in this example,
Explain a stop hunt again and show us what a stop hunt is.
this is the stop hunt. It's the false move.
Okay.
Yes, it's the move
The
again.
false move that's taking out stop losses.
Yes, it's also inducing people to put on buy stops in this case as a breakout trade. So most people are thinking, oh, breakout trade, price is moving higher.
What's your period length? Is this
Minute 15.
on a 15 minutes?
Yes, it's on a 15-minute time frame. As you can see, primarily in this study here, I'm watching the 15-minute time frame. You can see this language on a smaller time frame or even a bigger time frame. If it's on a bigger time frame, lights out, you're like a day, okay, you're like a week, maybe even. So this is what happens. Second leg, in this case, painted as a hammer, and it painted above the first leg.
What time does that happen? Is that the 9:30 a.m. move?
This one was in line with the midday New York. It was in line
9
with,
a.m.?
no.
So that's before it goes out to market?
Yeah,
I'm sorry.
before the market closes.
Oh, so this is in pre-market.
So here it was 1845 in South Africa, which means it was around about 1700. Not 1700. It was around about I think 11 a.m. in America.
Okay.
Yeah, like during the
So what
day.
about like the New York? I'm kind of curious to see what the New York Open move looks like. Because I know a lot of people, like they'll trade at
Here
9:30
it is.
a.m. soon as New York opens, and then
Here
that's
it
it.
is. So this is 1600. Basically in America, this would be 9 o'clock. New York, this would be 9:30 in here. 9:15.
So that's the false
9:30.
that's the false move right there.
Exactly.
Right.
And it's in line
Ooh.
with the session changeover. This is the end of the London. They stay there 15 minutes, and then at the New York Open, they shift price away from the high price points. In here, price is shifted away as a first leg of a big M. This is a big M in here. This would be the first leg, and this would be the second leg. And the second leg is comprised of a proper M formation. They just properly draw out an M formation for you in here. So this could be considered the first leg of this M, or you can just consider it as the second pulse. So this would be your first, this would be your second pulse, and then in here, contained within this structure is your third push to the high, making this your first leg. Otherwise, the session changeover came in here. And look at how price fails to keep closing above that number. Above that.
It's resisted, yeah.
Yeah, above that London close number. So every day, let me go check it out. Let's go to the 4 o'clock. There it is. And in this case, this was the open of this was the end of the London session. The New York session opened in here with this big red candle coming in here. And then it introduced a big push to the upside. So in here, basically, there was over 2 hours of candlesticks in the same area. When there are more than 8 candles in the same area, it's just a consolidation. So let's say, for instance, you're anticipating that this is an M, and there are more than 8 candles from the first leg in here all the way to here. Okay, let me just.
So when you say when it's more than 8 candles, that's a
It's
consolidation.
a consolidation.
And so
yeah.
that's when it's trading sideways
Yes.
for that period.
Yes. So essentially, what this could mean is that market makers have a different objective in price or with price. So around here, they had 7 bars already. This would be the 8th one. If you are in this trade on the first leg here and they present an 8 candle, you look to take your small loss or your profit. Let's say you were in here, you take a break even or a loss on that trade. And then 30 minutes later, this happens. This should be your reason to re-enter the market. When there is a bearish engulfing candle that brings price beneath this high over here. Same thing about this here. When you start your clock on the first leg here in the US session, and then at about 11 o'clock New York, you see that price is not going down. You take your lumps, then you wait again. And then look at this. 30 to 45 minutes later, there's already a setup for you to come back into the marketplace. That's what I did the other day, by the way. We discussed this in the group.
So you would put like a put on that and then hold?
So initially what I did the other day, I think I came in here and I took the sell in here and I saw it go down. Then I simply trailed a stop loss and I put it right on top of the orders. Then when it was coming back up, I knew that it was going to hit the stop loss. So I just clicked the bulk operation button on my MetaTrader 5 on the phone. So this closes all the trades. And then it went above where I initially entered. When this happened, I entered again. And this is the one I posted on the Discord.
And this is all off of you looking at the M pattern.
Yes, absolutely.
And you saw basically, and mainly the consolidation, the false move up, the M, and you're taking your trade on the second leg of the M.
Yes.
And you're also considering the candles. And just so people know, like, because I see you refer, I see you refer to the bearish engulfing.
Yes.
Which I would recommend everybody look at the Candle Bible in the Discord, because basically a bearish engulfing is when the bearish candle engulfs the previous candle. Yeah.
So I'm looking for a candlestick pattern like this. So why am I highlighting these ones that are in the middle of the range like this? You will see these candlesticks paint in the middle of the range like this. They don't matter at these price points. The price points at which the candle pattern matters is at the M or at the W. Excuse me. So yesterday, I took this consolidation in here. And I took this as my 3 pushes to the high side. On the third push, there are 3 big candles. When this happens on the third push, we call these candles vector candles. Vector being the term that is implying size and speed. So when you see these...
Can you repeat that?
Vector.
What type of candles?
The vector.
Oh, vector?
Yes, vector. Like an engineering term or a physics term. Vector candles. Okay, what this simply means is it suggests size, volume, and direction. So in this case, we got vector candles pushing to the high side. Let me
AKA momentum. I usually call them momentum candles.
Yes.
The big candles.
So 1, 2, 3. If you see 3 big candles and then all of a sudden 1 candle replaces all 3 candles, something spooky is happening in there. Like how in here the shift candle replaces that entire 45 minutes worth of damage when it comes back to the downside. All right. So this was the M and I traded in here yesterday. I traded right in there. Let's go back on the WhatsApp. I think I posted in the group. Where's the winner's circle group chat in this? All right. Let me remove all annotations And
And I know that's like a thing to look for too. Like if you see big candles, then all of a sudden you see small candles, that means like the momentum is slowing down.
exactly.
Like, so when you're looking at the market, we're trying to look at multiple variables
Yes.
to basically go with our analysis.
Yes. So that's quite a good
Can
question.
you repeat that? You said if you see the big candles, then the small candles. And what did you say after that?
Yeah, because you're kind of looking at like the candles represent buyers and sellers. So when you see those vector or those momentum candles, it's a lot of momentum, a lot of buying activity happening in the market. Then when all of a sudden you might see candles that are smaller, it kind of gives you an indication that that momentum is slowing down.
True.
And it could be reversing.
True. So essentially, I'm a reversal trader, and I trade the reversal away from an M or away from a W. In this case, here's an M formation. We got the first leg, so price was pushing annotations. Okay, that's true. So price was pushing up. 1, 2, 3. All right, right in here. 1, 2, 3 pushes. So this would be my spiking candle that introduces the first leg of that M, that big fat M. And that spiking candle is then followed by a railroad track pattern. Railroad track is what we call engulfing. It's what we call, what did you call it again, Gia? Simply just one candle up, one candle down. All right, one candle up, one candle down. And
I know that's a railroad as well.
Yeah, it's a railroad track candlestick pattern.
And at that point, once if you start with the buy, then you start with it being sold, is that then indicating that it's
going to be selling? Yes.
Mm-hmm.
But at the high, after price came out of a consolidation.
At the high, ooh, good. Okay.
Yes, so consolidation, we get a stop hunt, GIA, 1, 2, 3 individual pushes. That's how you identify a stop hunt. Sometimes it won't be clear. Trust me. That's why in the first lesson I came up with the advice that it will take extreme screen time for you to see the stuff that I am able to identify at a first glance. All right?
Yeah. And I do want to note to everybody, like, the market always moves in a structure.
Yes.
So you're always going to see a push up, then a pullback, a push up, and a pullback.
Exactly.
And yeah, so kind of keep that in mind on those stop hunts.
All right. So what happens then is this is the pattern we get where price trades above the first leg. And I said the conditions for this to be okay is if price closes as railroad tracks or if price closes a pin. And in this case, price does both. Again, Gia, to go back to the point you were making, that if price was having straight green candles coming up, look at the stuff. There are no pins on the top, no pins to the top, small pins, all right? Small pins. Now you start seeing pins to the high side. Why is price moving away from the high numbers every time it paints a high number? That's what you should be asking yourself. Firstly, there were no pins, small pins, and then the pins start getting bigger. Right? They start getting bigger. And then all of a sudden, you get this monster candle. This monster candle has a name. It is called a liquidity void. I'm going to go back to the MetaTrader right now. What a liquidity void is simply a gap in the marketplace. And after this, you should anticipate a retracement. In this case, it also introduced a reversal. Which is why I entered these sell trades. Here initially I entered quite early. Let me just draw. remove all annotations. I initially entered early thinking that price is going to close downwards, and that's why we don't trade on open candles. And then I kept scaling in as a martingale. Basically what a martingale is, you adding risk in a losing trade. So I added risk in that losing trade because I was watching a smaller time frame and I was able to identify that price was in fact going to fulfill my anticipations. And so it did. And when it did, I scaled out, which simply means I closed these trades in here. I closed partials. I closed these trades in here, and then I held, the other sets of trades. So I'm going to speak about how to
You
enter.
secured your profit.
Yes.
He took some money off the table,
Yes.
secured some profit, and then let the other trade run.
Essentially,
So there's multiple
yes.
trades at work then, and then you have those stop losses, or actually just as far as one trade or one group of trades going, you get out for that one, and then ride it for the rest of them. For that big candle that's hitting down, then
This one.
what's that timing like on a period? Because I know you said these are 15-minute periods. Is that still on anything that's as far as a differentiation between the New York stock market, or does it not matter? Or does it not matter at that point?
Actually, it does matter, buddy. And I think this was around the lunch hour, New York time, yesterday. It was yesterday here in South Africa. It's already Saturday morning here. Okay. Let me just get the crosshair and match it up. Yeah, it was around about midday New York, 12:30 midday New York. So it was 12:30 in New York during the day. So what happened here is price came up. Okay, let me just show you here. This is where the session opened. 9:30 New York. So false move, session beginning. You remember when I said price will consolidate at the end or at the beginning of a session? Now identify the small. Let's say you're opening the minute 5 time frame. This is a full on consolidation there. Then you get your false move. 1, 2, 3. Price is now trading above an old high. That's another way of seeing this. There's an old high resting there. There is some form of buy money resting above here. Retail traders are looking to go long when price breaks that price point. And the only way they can go long in here is if they are given a dip. Because buy the dips in an uptrend. Right? They'd sell in here.
Wow.
Place their stop losses in here. Now you understand what that candle is for. Do you understand what the candle is for?
Yeah, at that point, it's just to take the money. Because
Yes.
the setup is for the retail trader.
Exactly.
At that point, there's a resist to that price at, looks like 17483 or thereabouts,
483,
maybe even
yeah.
higher. But it's a setup because of that first open and then the drop. Okay, I see.
Exactly. So it's a shift candle. That's the name of the candle. It's a shift candle. And not only is this a shift candle, it's a liquidity void. And that is why price retraces back into. That's why price does this. It retraces back into that area and then continues dropping. This area is an imbalance in here. It's an imbalance according to the study of Michael Huddleston, ICT. Let me remove the annotations and just draw what an imbalance would be in this case. Okay, we have this swing low, and then this candle pierces past that swing low. So essentially the close of this down close candle and the open of this down close candle the area in between is treated by the algorithm as a gap. And that's why I didn't bother speaking about gaps initially, because I'm still going to speak about this stuff. So the algorithm treats this as a gap, so it retraces back into that area and then continues going downwards, because there's some form of money sitting in here. There's some form of money sitting within this area in here. We'll discuss this stuff when we speak about the candlesticks. Today, I came to speak about the pattern, and I haven't answered the question, the initial question with regards to the W. So with the W, price will go into a consolidation, come out with 3 pulses to the low, offer us a first leg, it will pull back, then it will offer us a second leg. Sometimes it will go beneath the first leg. The pattern for the candlesticks in here should be railroad tracks or a pin, a hammer. Let me draw a pin. Okay, say it has a pin downwards like that. You enter in here on the close of that pin. Alright? You enter your long or you buy in there. And then you get your true trend, which should last 6 to 8 hours. Yeah, sometimes you're going to get in the trade, and the trade is up big, 45 minutes, 3 big candles. That's also okay. Sometimes it might be 1 big candle. Especially with gold.
Can you repeat what you said? You said the indicating candles after the W are the railroad and two. What are the other two?
One candle down, 1 candle up, or you can get a hammer. Or you can get what is called a bear harami. No, a bull harami in this case. A bull harami would be something like this. So it introduces the W for you. Second leg of the W, and it's a bull harami. Okay.
Which one is the bull harami? What does it look like?
Looks like this one in here. Let me just erase this candle in here. It's called a bull harami because of how the next candle engulfs it. I have software that actually names these out for you. I'll be happy to give you guys that software. Okay, so with regards to today's lesson, the pattern, I need to detail this stuff for you guys. Okay, I spoke about what is called a chart markdown. Actually, what a markdown is, it's a breakdown from a bigger time frame. Namely, I use Alright, these are the time frames I use. Let me just change the fonts on here so people can see. Alright, so mainly this is what I'm looking for when I am trading. Okay, I'm looking to start from a bigger time frame and move downwards into a smaller time frame. So what this allows me is I get to see the bigger time frame's underlying premise, and not only do I get to see the bigger time frame's underlying premise, I also get to look for, let's say it's an uptrend, as you can see on the Nasdaq. What I do when I get onto the minute 15 and the hour 1 is I'm looking for setups that are going to be in line with the buy trend that is happening on the daily charts. Essentially, by moving in or by changing the time frame from the daily to the hour 1, I've got an echo again. I'm zooming in. Why am I zooming in? One candle on the daily is represented by 24 candles on the hour 1 chart. Simply, this is more candles. More candles means more data. That one candle in there is made up of 24 candles on the hour 1, 96 candles on the minute 5. I won't bother dividing into the minute 5 and the minute 1. I wasn't really that good with high school math. Okay, so you're looking for a pattern, a simple pattern. I don't know, this chart isn't allowing me to move more leftwards. I think it's because this broker has some form of issue. I don't know. Okay, let me just toggle, go back. All right, so what pattern are you looking for? You're going to have a big O moment. By the way, this is not Elliott wave. So price will come out of a consolidation. It will give us a stop and low. This gives us our W. All right. Price is pushed up and moves back into a consolidation. This could be a sideways move or a V bottom move. All right. When this happens, you're going to call this 1. All right. Price moves out of that consolidation as a straightaway move, and then moves back into a consolidation. This secondary push here, you're just going to label it as 2. All right. You'll most probably get a stop hunt low, maybe a V bottom, and then a third push to the upside. So this is where the third push starts, and this is where the third push ends. You'll then get an M, and then price will reverse back into the range to give you your 1 again. So you're going to get level 1, level 2, level 3. Sometimes you will walk up to the chart and it will absolutely look like this. If it looks like this, lights out, it's your lucky day. Simply, if it looks like stair steps, lights out, it's your lucky day. If you can count to 3, you can trade. Is everyone still here with me?
So I have a clarifying question then. What are you looking at as far as, so are you cycling between different period viewpoints then? Or where do you pinpoint in for your control, like your control view to do these moves?
Buddy, I think I don't think I understand your question, but let me answer what I think I understand. I use the level counts so I can know which part of the cycle I am in. So this would be an uptrend. Once I identify let me just remove this, put it in the middle here for now.
I think one of the questions he asked was in regards to the time frame. I think sometimes when we're looking at what you're showing us, you know, depending on the time frame, we may be looking at, it might look completely different. We may not see the three legs up depending on what time frame. So I think I see it right now. It almost appears that you're showing us the daily time frame in this chart. Is that correct?
Yes, I am absolutely sure.
Appreciate the clarity. Yep. That's exactly what I was trying to get.
So from a top-down approach, if we're looking at the daily, we're starting here, but we're not making. I wouldn't assume we're taking action based off of a daily. What time frame would you really be using to indicate that we have made it to the third leg up?
That's a good question then. I would be precisely looking for this pattern, or primarily looking for this pattern on the minute, not the minutes, the hour one. And it can even look more definite on the minute 15. Can you guys still hear and see?
Your chart's gone. I see something else now.
Yeah, you should be seeing a trading view.
Yeah.
Yes.
Yeah.
Trading view's opening.
Yeah, you should. I'm just trying to go to NASDAQ because I want to explain what you just asked right now. It's a brilliant question. The pattern can be seen on any time frame. That's what I'm trying to get to. The pattern, dare I say it, can be seen on any time frame. Let me change the time frame to the week here. And I just want to emphasize this point here. I just want to emphasize this point. So the pattern can be seen on any time frame. I'm just going to start in here. W, V, V, M. This is the pattern that I just drew for you guys a moment ago. Let me clear all annotations for anyone who wants to argue. All right.
No arguments.
So on any time frame, this pattern can be seen on any time frame. And in fact, this is how I was able to predict this. Okay, I was yet to get to this pattern. This is for the downtrend M, A, W. So I simply used those letters M, A, W. I don't know if this stuff is popping up on your screen as well.
We see it.
All right. So this is what I'm looking for. This is just absolutely what I'm looking for. Let me just zoom in on the daily, and we're going to be watching those couple
This is
of...
cool. I like how easy you make it.
It looks easy, Gia, but then when, for instance, you're looking at the market like this, and the market looks like this, most people won't be able to identify that this is an M and an A, and then that the next move is an A and a W.
No,
And I
I
think
know, but you give us something to. I just like how it's very simple.
It really
And
is. It really is.
I want to be able to identify the patterns. I think that's important. But also, if I'm doing a intraday setup, or as you had mentioned, you're waiting for a couple of hours.
I'm getting to that.
Would...
I'm getting
Okay,
to that,
good.
buddy. Yeah, I'm getting to that. I was just trying to emphasize the points that this pattern can be seen on bigger time frames and smaller time frames. All right. So that's what I'm trying to get to. For instance, when I issued the signal in the older group chat about how price was going to go long like this, I simply just I'm going to go show you the stuff. M, A, W. Okay. V, M. I'm looking for an M. I'm looking for a reason for price to reverse on the bigger time frame. So I zoom in onto the smaller time frames, and for this I'm just going to use MetaTrader. We could use TradingView, but then this is why I want to use MetaTrader. Let me just remove all annotations.
Wow, it's correlated to the volume too.
Yes.
At each of those.
Yes, it is. Because if you're going to look at the volumes, for instance, on an intraday perspective, especially the minute 15 chart, you're going to see that this is what happens to the volumes. almost every day. Almost every day. The volumes are the same. They act out the same way every day. Let me just erase that. Yeah, like this.
For example, sorry.
For example,
That was my phone. I touched it.
no problem, no problem. So, what are we looking for? This is what I want to get to now. You're going to be looking for a very, very simple pattern, but then when it comes, or with regards to identifying the pattern, it takes extreme screen time for one to be finally able to identify the pattern, because there is a variation on the theme of the pattern. What do I mean, a variation on the theme? Yes, sometimes you get it nicely stair-stepped, MAAW, but sometimes it will look like this. It will simply look like it's just a big consolidation range, whereas it is not. It's the market maker's pattern. M, price moves back into a consolidation. Simply then, this is our A. Price moves back into a consolidation. And then this is our A. Price moves back into a consolidation. This entire thing is a consolidation, in fact. It's consolidation. Then we get a stop hunt low to get us our W. So it wasn't stair-stepped, but you were able to use this pattern: consolidation, stop hunt low. So this is the variation on the theme. So A gives us 1, 2, 3 pushes to the downside. Actually, let me get, for those who are visually impaired, 1, 2, 3. So we get 3 individual pushes, 1, 2, 3. Then you get your W, then price rises the hell out of there. So primarily, you're looking for this pattern on the hour 1 charts. Excuse me. Let me just scroll back. I want to scroll back a little while back. I'm sure I'm going to get a proper, so this is why I'm looking for a W in here, a big V, probably a big V, and then an M above that structure. That's the highest probability that you can get. I just want to look for one that is simple to identify, and one that I've traded before. I think I've traded in this one before. This is the one that introduced that big uptrend on the daily. I'm trying to zoom in. Here it is. By the way, this pattern is best comprised over 3 days. Alright, sometimes it won't happen over 3 days because of the objectives that the market makers have, but it's best over 3 days. I remember that I took this buy in here. Also took this buy in here. Let me toggle. But before I just continue with this one, I just want to show you guys this stuff before we actually, I think it came out of the old group chat, traders community. I took everyone out of this group chat. People came in here and posted porn in here, so I had to protect the people who are in the group chats and everything that the group chats stood for. And I put them in the much newer. Okay, this would be on my phone. This would be on my phone then. Let me check if I sent it to Lwando. Yeah, okay. I don't think the stuff is going to load up. It doesn't. Okay, nah. Let's leave it. Let's leave it. I'm gonna post it in the Discord. I'm gonna find it and post it in the Discord. But I took this trade as a Head and Shoulders reversal pattern. So simply this was the anchor point low, W, APL, anchor point low. Okay, this is my anchor point low W. Price went up, moved back into a consolidation. When it moved into a consolidation, got a V, but then price failed to continue upwards, and then it came back into another V bottom beneath this old low. Then you got a bullish engulfing candle, then price pushed upwards. What this is to me is it's a second push upwards. So remove all annotations and let me simplify things. W, V. All right, looking for secondary V. Price pushes up. This is my secondary V. Who had the question about the gaps? Here it is.
Yep.
Here it is. So you can get these sickening gaps, especially on Mondays. And that's why you don't leave your trades over the weekend. All right? That's why you don't leave your trades on the charts over the weekend. All right? So this would be my first level. This would be my second level. This would be my third level. And the third level is comprised of 3 individual pushes. Let me show on the side what I mean. It's 2, then 1, 2, 3. This is much better when it happens on the minute 15 chart, when you're watching it on the minute 15 chart. And that's what I'm going to be doing primarily with that 6th of October. What is it? 7th of October setup. So from the 7th of October all the way till the 11th of October up in here, that's what was happening. There were 3 individual pushes. So this is an entire consolidation created by that gap. And then you get your 3 individual pushes, then a reversal. Otherwise, in turn, let me remove all annotations as a stair-step anomaly. That's what I'm looking for.
So are you not getting in on any of those pushes on the retest?
On the retest, which retest?
I mean on the retracement, like on the retracement of the push. If you know like it's gonna do these 3 pushes, are you not gonna get in on one of those pushes at all?
I do.
Okay.
Yeah, that's a good question.
That's what I would think. Like I don't like looking at the charts all day.
Yeah.
I want to just find, if I know, okay, it's gonna push up, pull back, push up, pull back. I feel like
that's a brilliant
okay, I might want to
question.
get in on one of those pullbacks, ride the push up, and be done for the day.
Yeah, that's an absolutely brilliant question, because, and also a brilliant anomaly, because think about it. You're not going to be sitting and staring at the charts 24/7. Number 1. Number 2, you're not going to be trading every day.
Mm-hmm.
Yes.
Like I have a friend that she gets in, her trades are like 9 seconds, and she's making between $1,000 and $2,000 in 9 seconds, and she's done for the day. She's in and out, like a robbery.
That's quite a good perspective. But then activity doesn't breed success.
Her way of trading kind of makes me nervous though.
Yeah. High frequency trading is a trap, especially for the guys who are still learning. All I want for these people who are...
Tell me about it.
Yeah, for the people who are neophyte traders, I'm just looking for you to place your trades at the high of the day or at the low of the day. Like, look for this pattern.
Thank you. That's what I was gonna ask you. What I was, and I hope I'm not cutting you off. Let me shut up and let you say what you were saying, because I'm trying to. I see the difference here. We get into between October 6th and October 9th.
Okay.
What I know to be a gap, and I just want to be clear on this, is the difference between October 6th and October 9th. You see how October 6th ended. I want to say at that top, you're about to be there now. And then it opened up on the 9th at the bottom. The gap, to my understanding, is the difference right there. The difference between that move and there. That's the gap. That's the gap that I learned in options. And usually they say when it opens, you're waiting for a gap fill. So you're waiting for it to go up, which is actually what it did that day on the 9th. It went up. So, most of the savvy investors I know, they would be waiting for that gap fill.
Okay,
So
now I
explain to me,
understand your question,
explain to
buddy.
me that.
All right, all
Excuse me?
right. Okay, so let me explain the gap to you as or for my understanding. All right. So this is what happens in the marketplace. We read price from the left hand side and we go all the way to the right hand side. Okay, you get this, right?
Yes.
Okay. Price can either do one of three things. Price can go up, price can come down, or price can move sideways.
Mm-hmm.
All right. A gap is this. Why am I saying this? A gap is essentially reasons for the market makers to stop price and move it sideways. Most textbooks tell you that price is going to trade back into the gap and close the gap up.
There you go. That's the term I've heard. Close the gap up.
Yes.
Trade into the gap.
It's a marketing ploy, buddy. It's a marketing ploy. It depends on what is happening in the marketplace. In this context, price only closed that gap because the underlying premise was still an uptrend.
Okay.
I know Luando says especially with NASDAQ, if NASDAQ gaps down, look for it to continue gapping down, to continue trading downwards. And he knows what he means when he does that. He knows what he is looking for when price does that. But then with me, I just see gaps as a different story. This is why. I made an annotation like this here. Okay, I'm not trying to throw out support or resistance. This is an old high. Now gather this. Price pierces the old high with a big candle. The name of this candle is a liquidity void. Go back in the recordings when you're revising this lesson. A liquidity void is a reason for market makers to trade back into that area. So price rallied up all the way into the close on this day. And then at the open, when price had to open up, they opened price up somewhat a couple of 100 points away from the close, back into the liquidity void. This liquidity void is essentially a gap that price will trade back into. Only that this time it has been presented by a big candle. This big candle is as good as this empty space. So we got a swing high. We got a candle that pierces a swing high. In that sense, price will be trading back into this. It's a gap. Let me remove all annotations. I've got too much lipstick in here. I will be speaking about this stuff in detail. There's a different lesson for this. I just don't want to say to you that you're jumping the gun, but because you're so curious, you won't listen to any other thing that I have to say if I don't tell you the stuff. I just thought I should get it out of the way. There is an individual lesson set up for this. For instance, how price breaks the swing low with this candle in here. Look at how price retraces back into that before dropping again. Again in here, this is a swing low. This is the candle that pierces the swing low. Look at what happens in this area when price comes back and it trades back into it. It's an imbalance. An imbalance is a form of gap. The algorithm treats it as a reason to go back and mitigate or close up that area, like in here. That's the only reason why price retraces back into gaps.
Can you repeat that?
Essentially what happens is the market maker, okay, opens up a gap. It leaves a boatload of money sitting there. There's some buy money sitting there at the close of this day. People were buying the market in here, all in here. Traders were buying the market all up in here. Why were they buying the market up in here? Breakout traders.
They're buying the market because we were in an uptrend.
Yes.
So they felt confident and they started to buy the market. We went up, we stopped out, and then we opened back up into a gap. They're not going to buy again because they don't know. They're waiting. They're either waiting to get back up there to sell now, which is probably going to push pressure back down, but that didn't happen. It kept going.
Exactly. So what this business is, it's the money. And the money is resting, dare I say it, above an old high and beneath an old low. Money is resting above an old high and beneath an old low. Money is resting above an old high and beneath an old low. Okay, This is called liquidity. There's also a different lesson for this.
Liquidity grab. I've heard that term, liquidity grab.
Yes. Here's a liquidity grab for you on the upside. These are relative equal highs. This high is relatively equal to this high. So this structure in here, which is a consolidation in this case, is a liquidity grab. Price simply traded above here, convincing the retail world to trade it using buy stops. So yeah, I think I have a paper trading account on this one. What am I supposed to be doing? Okay, this. All right. So this entire level counts is what makes this market makers method business quite a hassle, and it's actually what you need to then use as the best way of learning. Let me just 2023 10 12. What's happening? 10. Let me just take it for 12 days. And then where's the speed? Okay, the speed is on the strategy tester. I don't know, is it opened? Oh, there it is. I'm not going to be using this indicator. I just use it so the thing starts working. Oh, my bad, my absolute bad. Let me just correct this. I need to put on the NASDAQ for now, for this. I want to back test for you guys in this lesson what was happening on the NASDAQ. Jeez, man. Okay, then I can't quit it that way. Exactly, that's what I'm looking for. Okay, now this is what I want for you guys to see. So I want to do a quick chart setup. Can you just bear with me for the next 30 seconds? Control G, Control Y, FN, F8. Black on white, we're looking for bull is green, bear is red. Can you guys see if this is the setup that I'm using? Okay, the rest of the stuff is short stick volumes. I don't think it's necessary, but I will. I don't use the volumes. All right, so let's say you were just looking at the chart like this and you didn't zoom out. For some strange reason, you're a strange person who never zooms out on the chart, yeah? And you're looking at the chart like this. Can I just pause the simulator right there? I'm going to take the pen and I'm going to be looking at the previous week. So from here, I'm going to go 1, 2, 3, 4, 5. And I'm going to start reading price from here.
Is this a daily chart?
No, this is the hour one, buddy. It's the hour one.
Okay.
Yeah,
Okay,
you can see in here.
Oh, yep, I see it. H1.
Yeah, it's the hour one. So
right.
Let's say you woke up to this chart. You identify that there is a predefined low and that there is a predefined high. Zegude, why are you taking the candles and not the wicks? It's because if I were to put on a line chart, see, the pins aren't there. The pins aren't there. All right? So that's why I usually use the closes or the opens of the candles rather than taking the pins. If I were on a smaller time frame, of course, I would be taking the pins. But then, yeah. So this goes back to saying, do you remember the pattern that I had initially discussed with you? This pattern here. Then it moves back into a consolidation. If you don't, please go back in the video. Then I said you do this. This is what's happening in here, guys. Price came out of a consolidation, gives us a W. In this case, I don't want anyone to. Sure?
Yeah. No, go ahead. I want to see what you're doing.
Yeah. Yeah, I know you're going to ask, doesn't it need to go above here first to confirm the level?
No. I see it. It fell. So since it kind of, whether it goes down or up, it's outside of that consolidation that you had just drew. So we're waiting for the W to come back into where you just said it needs to come back into trading. So that's like a liquidity grab in a sense. It's going down there. It's stopped. Everyone's stop losses broke out of their stop losses and took their money, and now it's going to come back up. So we're waiting for it to come down. But what I want to see is that last line you just drew is kind of like, are we using that as our bottom? Are we waiting for it to come down there? Because it even went below that too. That would have fooled me. I'd have been out of there. I'd have lost some money, or I'd have been scared to get back in.
Okay, I'm not quite sure with what you are making reference to. Where would you have entered? I think you're speaking about losing money.
At 14, where you have it right now is at roughly 14,536, right?
Yeah, right here.
Where are we saying it opened at? When would we have seen this chart? Like you said, if we were looking at this chart from here, I would have been waiting until evidently it would have already played out. This activity already happened. So
yes.
Right now I would have been waiting for it to go up.
Yeah.
And then waiting to sell. The only play I see is a sell because we have two green candles on the way up. But if we're backing up, going back there, that's why I was saying I would have probably lost because at this point, not that I would have lost, I probably just wouldn't have got in because where you just drew the W, it just broke out of that range. So
Okay,
it would have
buddy.
been
Yeah,
coming back
yeah.
up.
That's a good question. I'm actually heading towards that. So you see leftwards here, that's a low, right?
Yes.
Okay, this low here is an old low when you are referring to this in here.
Correct.
I'm gonna go back.
Algorithm. That old algorithm is no good anymore because we're not trading in that algorithm. Once we fell below 14,536, we had to go further back to the left because nothing that I see in this current window is telling me what's going to happen now that we got down to 14,760, 14,456. So,
But you have
that's why
you have everything you need in this time frame, in this view, and I'm about to get to that right now.
Okay.
Yeah,
It gave us a nice railroad right there.
exactly.
That railroad is what. So that railroad would have been enough. That green candle that came after the red one. That railroad is what. Yes, that's. But before that is what I was saying. That railroad is what I would have needed. I would have needed that green candle would have been one, but I would have probably needed the fourth green candle before the fourth green candle before I would have been willing to get back in. Yes, that one.
Okay, buddy. Yo, this is the no trade zone. This is where you don't place your trades. That's where you don't place your trades. So what I'm about to discuss with you is the reason why you don't need to draw out these weird patterns that look like this. Ever have traders draw out this stuff? I don't do this. All right, I don't draw out those patterns. So I'm trying to get to the point that, okay, this is an old low and I'm going to draw horizontal level across. Leave it in isolation. This is an old high. I'm going to draw, okay, no, that's not what's supposed to be happening.
That's what I would do.
Yeah.
I would do the same. That's exactly what I would do.
Okay,
And
so
isn't that considered a gap up right there, that first? Isn't that a gap, like
This?
a fair value gap? No, this first one where your old low is.
this
How
one.
It gap, yeah.
Those three candles up.
This is a fair value gap in here. And we got
Yeah, I
an
was in a-
immediate rebalance of that fair value gap. But then, guys, can I just explain what I have to explain here? And
Yeah.
then we're
good.
gonna go ahead into what you guys are asking me about, because I think I have like 4 or 5 questions now in a row and haven't really answered any of those. So what's happening here is this is sell side liquidity. This is buy side liquidity. Sell side liquidity is simply liquidity resting beneath an old low, where in future you anticipate for the market maker to induce sell trades. In this case, I'm going back to the term that you made reference to. Do you remember the term?
Yes, liquidity grab. Yes.
Liquidity grab. So this is what defines a liquidity grab, when price trades beneath this old low. Okay, so by the time you want to enter on that trade, the trade is already done on this 4th candle here. This is the no trade zone. This is the area where you're not supposed to be placing your trades in here in this candle. It's a gamble.
What? Yes, I need to understand this because
Yeah. Let me just go into more detail.
I won't
as
say
to,
anything until you finish. I will shut up.
Yeah, let me tell you why it's a gamble. It's a 50-50 proposition, and it comes from the fact that we are trading this pattern on the minute 15 time frame. So you would take the second leg of the W and go and let it push upwards. All right. When this happens, you're looking to trade in here. Why am I saying in here? It's because price just broke the initial high of the day. Let me toggle and remove all annotations. Let me show you what I'm speaking about. This is the initial high of the day. You're trying to trade above that initial high. Let me take the opens and the closes of the candles rather than the pins, for argument's sake. If you're trading in here, you're essentially trading this. The professional guys do this. Don't do this, buddy. While you're still learning the strategy, don't do this. I need you to place your trades at the low of the day. And if you miss that, it's okay. Do you want to know why it's okay? It's because the next day you come back around, you've got the exact same setup. What, you don't believe me? Following day, you're going to get the exact same setup. And the setups are best when they come beneath an old low. When price trades beneath an old low, you're looking for a liquidity grab. What a liquidity grab essentially is the market maker's ploy to, induce traders to believe that this is what's happening in the marketplace. They profoundly induce an underlying premise in the marketplace. With this one here, it would be best if price would trade above that old high, this old high, maybe even that old high, but preferably this short-term old high here, and then downwards. So you're looking at liquidity in that perspective. You would be looking at the sense of liquidity, and that's why it worked in here. When price went above on this pin candle in here. On a smaller time frame, it would make more sense. Okay, that's why it worked when price traded above those relative equal highs with that. It works, buddy. It works, trust me. So you're looking for reasons to go against this belief. You're looking for reasons to go against this trend continuation belief. And reason number one is that when price goes past these liquidity zones, price is going to give you big monster candles. It even goes beneath this one. Actually, let me toggle. Let me show the stuff to you. It goes beneath this one as well. Okay, I can't draw a straight line. But I don't know.
The wicks were almost a good indication at the bottom of the wicks.
They almost are, buddy. They not. They only a good indication on a smaller time frame. Look at that. Gia, engulfing candles, the railroad tracks. Those railroad track candles go right in there and they tap beneath that low. On a smaller time frame, buddy, I wouldn't argue with you. I wouldn't argue with you. See,
So
price
your
never
entry would have
really
been- where would
reached
have
it.
been-
Pardon?
Where would have been your entry at the railroad?
The close of the green candle.
The close of the green candle.
This candle here.
Okay. That's a good place to get in.
This is my entry. Yes, I would take some heat on the next candle, but it's not enough to burn my accounts, nor end my career. Yeah,
Where would
that's
your stop set at the bottom of the green?
beneath the
I mean,
candles.
bottom.
If I were to put
Where?
on a stop loss, I'd put it here, beneath the candles.
Correct. That's what I thought. All right, great.
Yeah, so this would be my entry in here. Oh, what's happening? This would be my entry. This would be my
What's
stop
your
loss.
target? And what's your target profit?
My
Take
target,
profit.
my initial target profit would be the initial high of the day, which is in here.
Initial high of the day. Where are we seeing the initial high of the day from?
Okay.
Third, just the third. So
You remember the pattern I asked for you to look at on the minute 15? Let me just, I don't know. This thing seems to be
no, I
stuck.
know when you say high of the day, I know if you were talking about that was a third. That was a third of October was over here. So The high was all the way up to 14,879.
No, buddy. If you were to open the minute 15 time frame, you'd get the end of day, beginning of day consolidation, correct?
Okay.
So this consolidation is comprised of two price points. It has an initial high of the day, or simply IHOD, and it is also comprised of a secondary price point known as the initial low of the day, or ILOD. Let me do this.
Okay.
Oh, it's acting as a new annotation. Okay, no problem. So my take profit primarily from the low would be the
Based off
IHOD.
the lower time frame.
Yes, based off of the minute 15 time frame. It would be
Okay,
the IHOD. Why? Because the IHOD and the ILOD are the strongest support and resistance price points. This is your bread and butter go-to here. So if I were to take an M in here, the ILOD would be my first take. The low of the day, would be my secondary take before price moves back into a consolidation.
Okay.
Yes. So with this in here, you're just looking for the same pattern every day. You're looking for this pattern. Okay, in here I did this initially. I remember this is how I traded it this day. Why did I do this? On a smaller time frame, there is sell side liquidity resting beneath this low over here. I know it's the pins. You're gonna start arguing with me. As I've made the mention, it was on a smaller time frame that I was doing this, and then price traded above this high in here, giving me that information structure on the minute 15 chart. I didn't short this in here primarily because the underlying premise that I was looking for is an uptrend. So I waited for price to lucky for me, on the hour one chart, it did this with 3 big candles. Not only did price present this move in 3 big candles, it also landed in an area where I had anticipated for price to land. By the way, this is why I said your candle is a bad entry price points in here. This candle is an imbalance. It's a liquidity void from the price points of the close of this previous pin close candle and the open of this up close candle. This entire area in here is an imbalance simply because it broke the swing high. Price breaks the swing high with that big candle. The algorithm treats this area as a gap. So I think I'm answering 2 questions in a row here. So
Good information, right?
yes, so when the algorithm treats this as a gap, it initially comes back into it and it continues upwards as price delivers upwards. Where is price delivering upwards into? Okay.
Into the previous consolidation, into the previous algorithm.
Yes, it's going back into the previous imbalance. And
is that imbalance happening the previous period, or is that the day before?
This one is from 3 days prior. Okay, so if I were the day before, if I'm just looking at this one, it's an inefficiency. An inefficiency is basically an imbalance that price hasn't gone back into. So it was inefficient, and then price went down, it came back up into that inefficient area, leaving this imbalance inefficient. And that's why price trades from this imbalance in here and it comes back down into this inefficiency in here. Let me remove all the lipstick so things can be much, much clearer for you. That's what I'm speaking about. So this area in price is where the algorithm looks to be moving within without taking out the high nor the low.
Oh, okay.
So it's just going to stay in between. What this is it makes the traders indecisive, and that's why you get these textbooks speaking about indecision. All right, so let me just get to the interesting part of this lesson. So there is buy side liquidity resting in here. Okay, let me remove all annotations. Let me annotate. Clear all drawings. There's some buy side resting in here and up there, but I'm not interested in that one because it's from a much older high. I'm just looking to take this recent one, and I'm looking for price to pierce it, grab liquidity, and go down. And I'm waiting for price to, in this case, pierce this lower end, take out liquidity, and then start rising. Okay. So meanwhile, as we watch this stuff happen on here, I'm going to be muting my mic and I'm going to be taking questions. All right.
No problem.
So look at that. Will you look at that? So precisely speaking, these are the patterns that you need to trade when you're trading. You're looking for price points where price grabs liquidity, and this should be in line with the low of the day or a high of the day.
And then for clarification, those highs and lows of the day, those are your entries, correct?
Correct.
Like once you,
Okay, this is an imbalance where this would be the high of the imbalance and the low of the imbalance. And I just annotated why I'm calling this an imbalance. This is a high or swing high, and price pierces that swing high, continues above it, it runs it, it goes past it. What this does is it creates a gap, and it is this gap that we look for price to retrace back into. And in this particular case, the price closed up there and it opened down in here. What this does is it creates a big gap. So this new gap is now a reason for price to retrace back into it. All right, in this case, we are coming from this one as, can I call it support? I don't know what to call it, a support like that.
What do you mean? Wait. Why would you call what support? I just want to know what's
this candle in here, this gap down here. It's the reason why this gap is closed up.
okay.
Yeah, it's the only reason why this gap is closed up. It's because price basically came back on top of this and it took some money in this area in here in price and it drove price upwards. So I'm going to speak about liquidity in detail in a couple of lessons time because I still need to tie things together with the level counts. And what I was hoping to do is I was also hoping to check this out on a currency or the GBP USD or gold or something to that extent. So
But can it go down just as easily as it can go up?
can it?
Because when you say the liquidity, if just like you're saying, it's a gap fill, and that was the question I had before about the gap. I see the gap fill, and you kind of made me feel, based on something you said previously, that that wasn't enough of an indication. That is what I thought. I thought that gap was the gap we were going to fill, and that's exactly what just happened. But you made me feel as if something you said earlier that
Oh, I
the
remember
same
what I
way.
said earlier on, and I'm sorry for just rudely stopping you there.
Oh, you're fine.
Yeah, with gaps, buddy, it's a textbook ploy. It's a marketing ploy. So essentially, what I'm trying to mean when I say it's a marketing ploy, think of it this way: if the entire retail world thinks that when the market gaps, the market will close the gap, don't you think that market makers can in fact use this against you?
Yes, absolutely.
Exactly. So, for instance, let's go back to TradingView. I don't know if they displayed this on TradingView. No, no, actually, I don't know what's happening here. They want me to
Just
show you
click out.
TradingView. I don't use TradingView. Let me just click on it.
Are you gonna be Are you trading that gap? Are you looking at that gap like, okay, this was the high of the day. The next day it opened below
Right.
into consolidation. Are you trading that gap?
No, no, no. I'm not trading based on the gap. That's what I'm trying to explain here.
Okay.
That's
Yeah,
exactly
the gap is the ploy. That's how they get the retailers and they get their money off.
exactly.
Is that what you're saying?
It's
Yeah,
it's a reason
it's a trap.
for
Because I know
traders.
some people that trade those gaps. Like,
Yeah, I know a lot of people that trade those gaps, but they're looking for short runs. They're looking to make a quick 20 or 30%. You know, I think that's what I'm trying to figure out is what your strategy is. If your strategy is more of a intraday, if you're getting in, if you're looking for your entry point, then I can see why that wouldn't be your entry point. But
Or to
yeah,
answer your question, buddy, I trade on the minute 15 time frame. I trade the 15-minute charts. I trade
okay.
the M and the W pattern.
mm-hmm.
Yes.
Okay.
I trade either off of the high of the day or off of the low of the day.
Initial, I know, but you gave me these initial numbers. I was thinking, I wanted to ask you a question about that. You said the initial high of the day, and initial low of the day. Are
Exactly.
you staying with initial? That's what you base your. So if we're looking at that, when we go back to the Ninja Trader you just had open, I want to see what you would have perceived as your initial, as well as your initial high and initial low.
Okay,
When would it
are you
have been
speaking about the
fine? When
strategy
would it have
tester,
been fine?
right?
There we go.
Okay, that would be a good question. So at the changeover or at the so
And just so people know, those lines indicate new days. New days are starting.
yeah, the period separators.
Yeah.
All right. So I didn't necessarily recap. I thought I was going to do a recap in this lesson, but due to time constraints, I thought that it wouldn't be necessary for me to just go back into that. But then in the initial lesson, we spoke about how price goes into a consolidation at the end of the day and at the beginning of the day. So this consolidation is comprised of two price points, simply a high and a low. Let me just say, okay, let me draw out using a different object. Okay, a high and a low. Actually, let me caps lock on that one. Okay, this high, namely, is called the initial high of the day. This low, namely, is referred to the initial low of the day. These price points are best identified on the minute 15 charts. Since I was looking for an uptrend, I'm looking for an uptrend. Since I'm looking for an uptrend, primarily,
Entries at the low.
yes, the entries are the lows. It's the low price points. The low price points. Sometimes I won't get the low price points because I won't deal from the absolute low. I won't enter at the absolute low. Maybe I'll enter in here on the close of the engulfing. Maybe I'll enter in there, the close of that engulfing. With this one, maybe I would have taken a pass on the trade. Or I would have entered the trade as a consolidation trade around the low of the consolidation.
So my concern would have been a continuation at any point, would have been a continuation into yesterday's, because this was you call this candle an imbalance.
Yes.
The candle from the previous day. So I would have been concerned that we would have found ourselves back into yesterday's channel, which was below that imbalance.
This area in here, buddy.
I'd have been waiting for that low.
Is this what you're waiting for?
I would have, just because I'd have been too nervous because of yesterday's trading until we got into a new channel. That channel right there was, even these are hourly candles. So I really wish I could tell, I knew how much ticks each one of these candles were, how much movement we're looking at, because there might have been money to be made there, but I see one touch of the initial low, which was 1, 2, 3, 4, 5, about 7 hours in. So that would have been a long time waiting for it to get to that low, for it to take 2 candles back up to halfway through. I don't know how much money I would have made, but that would have probably been enough for me to say I'm done for the day, because that wasn't enough movement. I see 7, 8 hours of movement, and it just doesn't seem like a lot of movement to me until the end of the day.
Wow, that's quite a great analysis. And now it goes back to what I said earlier on about you can't trade or stay at the charts for 24 hours.
Exactly.
Yes, so that's why you use the timings, buddy.
But if you want to make money, you got to make a decision. So, it sounds like your decision would have been a buy. You would have been comfortable with a buy, and it would have worked out in your favor.
Yes, I would have been very much confident with a buy trade.
Why? That's what I want to know.
Okay.
You wouldn't be waiting for your 3 pushes?
To the bottom side?
No. You said it starts with consolidation, and then you're looking for the 3 false moves.
Yes, the 3 pushes to the low. Oh, that's quite a good question.
I see a train track.
Okay, so
I see the first push I see is a train track.
No, I'm not talking about. I'm on this day. I'm on the last day.
All right, I'm going to explain this. Can I just get to this?
Yeah, go ahead. My fault. Let me shut up. I do see a train track. I see 3, and then it breaks out of that consolidation.
No problem. I understand what you're trying to get to. Can I just use these 3 days to explain what I'm looking for? On this day, I get the ideal setup. So I trade this day. On this day, I get the ideal setup. I trade this day as well. On this day, I get a straightaway setup. What do I mean straightaway setup? Price goes into a consolidation and then just gets out of the consolidation. No questions asked. It's a straightaway trade. A straightaway trade comes as a market surprise to retail traders, and sometimes it comes as a market surprise to us as well, especially when we are over biased with what Gia is asking me, looking for those 3 pulses. Is this what you were mentioning?
Yeah.
Yeah. So this is the ideal pattern. As a beginner, I used to only trade this pattern. But now, with more and more experience piling up on my badge, I can also take these setups where I simply sell the high of the consolidation and I purchase or go long at the low of the consolidation. All right. The best way that I usually do this, entering on the lows of the consolidations, is if price, let's say these are the 2 price points that I'm given to start the consolidation off. I'm going to simply sell as soon as price goes above that old high, and I'm going to buy when price goes beneath that old low in the consolidation. So this is what I'm going to be looking for. I'm going to be looking for the range to keep getting bigger because there's more and more money sitting or being aggregated at a higher price point or at a lower price point than the previous number. And that's what I see right here. This is my low, and this move here acts as this anomaly. And this anomaly is what I just recently explained as a liquidity grab. And it would go back into your question. You know that in the textbooks they say that this will be filled up. So you can use this liquidity grab as your reason to consider that the market maker's price delivery algorithm is going to seek buy-side liquidity resting above that old high, and as a confluence of triggers, you're coming off of an imbalance and you're looking for price to move straight up. So since the market condition is not available for me on this day, the ideal market condition is not available for me on this day, what I do is I use a confluence of triggers. Basically what this is I would list down reasons to sell the market. And let's say I'd get like 2 or 3 reasons. And then I'll list down reasons to buy the markets. And in this case, I'll get like 5 or 6 reasons. And then I'll weigh my options based off of that probability. And that buy setups are a much more high probability setup as compared to the less confirmed sell setups. Again, I'm looking at this price point as my anchor point low. When I have an anchor point low, I am simply looking for a W, a V, and then an M. In this case, I have been provided with my W. This structure in here is my V, and this structure being formed in here is my V. Essentially, at the top, let me remove all the annotations. This is my W. This is my V. This is my V. I'm looking for my M formation and away from the high. Is this clear? Does this bring?
I understand it. I understand it. At least at the patience point, because you're not jumping in initially off of that first few rises.
Yes.
It's like you're waiting because you know what's coming next, or at least you're seeing the patterns.
Yeah. So
this is more or less of just like identifying that pattern beforehand.
Exactly, buddy. And think about it. In this week, you had your ideal pattern, your ideal pattern, your ideal pattern, and then day 4, all of a sudden you just get this. Day 4 is your reason not to trade. You didn't get what you were looking for.
Exactly.
All right, you didn't get what you were looking for. You only place or press the buttons. You place trades or you press the buttons on the day that you see a high probability setup. And I've just told you how to get a high probability setup. Initially, you just look for reasons to sell, and then maybe you're going to get like 1 or 2 reasons, and then you look for reasons to buy. You're going to get 4 or 5 reasons. The reasons to buy outweigh.
Confluence?
Pardon me?
What did you refer to them as? Confluence?
A confluence, yes.
Confluence of triggers on either side.
Yes. So you're looking for a confluence of triggers. Oh, hey.
And whichever side wins, you go with that trade.
Whichever side is more probable or has a higher probability of panning out, that's the side you trade.
Correct.
So
I would like to know what are the confluences. What are the things that you look at as confluences? What are the metrics?
That is a good question. Initially today I spoke about an OLHC. In this case, I'm looking for an open, a low, a high, and then a close. An open, a low, a high, and a close. I'm looking for an open, a low, a high, and a close. Since it's an uptrend, if this were a downtrend, I would be looking for an open, a high, a low, and a close. Alright, so that's what I'm initially looking for. What else am I looking for? Yes, I'm looking either for in this case, a W or an M. Minute 15 charts. I'm looking for the level. What level am I in? Am I in the W? Am I in the V? Am I in the V? Or am I in the M? Essentially, between the W and the V is level 1. Between the V and the V, it's level 2. Between the V and the M, it's level 3. Level 1, level 2, level 3. And level 3 is comprised of 3 individual pushes. 1, 2, 3. Okay, let me toggle. Let me just first clear all annotations. Okay, let me not do that.
But those are days apart. So
Those are days apart, pardon me?
yeah, those moves are happening
Days apart, yes. They're all happening days apart. And that's why I said with this pattern here. Okay. Let me go back to the text. With this one here, this is what we were speaking about in the previous class called the market condition. It happens on the minute 15 time frame. And this is where you identify the consolidation, the stop hunts, and the trend. Consolidation, stop hunts, and the trend. Okay. So I'm going to say con SH trend. Okay. Can't really put up the trend. Let me just drag the box and see if the text box is much bigger. We can do more justice. Yeah. So I'm looking for the consolidation, the stop hunts, abbreviated as SH, and the trend, abbreviated as TR. Gia, to answer your question, yes, each and every day I am then looking for consolidation, stop hunts, trend. Consolidation, stop hunts, trend. Consolidation, stop hands, trend. Pardon me?
Call it stop hands?
Stop hands. Stop hands.
Stop hands.
Stop hands. You are hunting for stops.
Okay.
What stops?
The bottom of the consolidation. So we identify consolidation, stop hunts, and trends.
These are all the stops the market is looking for. In the stop hands, the market maker is essentially looking for buy stops, sell stops, or take profits and stop losses. Okay, so the confluence of triggers would be the price points. Am I at the low of the day or am I at the high of the day? If I'm at the low of the day, I'm looking for a W. If I'm at the high of the day, I'm looking for an M. Since I've achieved the high or the low, what market condition came before this? A consolidation and a stop hands. Then I'm at the high or at the low. In this case, I'm looking for the low of the day, so I'm getting a market condition of a consolidation, a stop hunt, and the trend. A consolidation, a stop hunt, which is a false move, and then the trend, which is the true directional premise. Gia, to answer your question, in this case, yes, level 1 is on an individual day. We get 2 days of consolidation, then we get our level 2. We get a half a day of consolidation, and then we get our level 3, which is comprised of 3 individual pushes. If level 3 starts in here all the way up there, then level 1 should be starting up in here on the second leg of that reversal structure all the way back down in here. So you're looking for this pattern, W, V, V, M. The W on the smaller time frame is going to induce the market condition of a consolidation, stop, hunt, low, and then the trend is going to be a buy trend. All right, so let me just toggle right here, remove all annotations, and zoom in. Primarily, okay, what day was this? The 9th. I'm going to start with the 8th, and I want to show you guys this stuff, and then we can end the lesson off of that. I see people getting out of the lesson, so we've been going for quite some time. I'm going to take this to like the 17th or something, and I'm going to be relatively moving quick. Should be able to start. I don't know what's happening. Okay. Get that. Okay, let that happen. Okay, so let's do this. And then I'm gonna go again, Control G, Control Y, Fn, F8. What happened? F8. Start responding. Okay, there it is. Absolutely not responding now. I don't know what's happening. Ladies and gents, can you hear and see my screen still?
Yeah.
Well, I don't know. This thing kind of froze on me. I just wanted to get at what you were saying. This is an individual week from the 8th. I think the 8th was a Monday. Okay. I don't know what's happening. Can I just... No, I can't. Okay, let me go back to the MetaTrader. Stop this. Restart it. Yo, okay. Seems like we have a little bit of a bummer here. Okay, I think I'm able to close it now. Open the new instance and yeah. Okay, so I should be able to move relatively quickly off of this one. Ladies and gents, trading is not simple. That's one thing you should get out of your mind. Yes, it becomes simple as you learn and you simply become more and more proficient. I don't know what keeps happening here. It just all of a sudden freezes on me. Okay, so with regards to trading is absolutely not easy. It's not easy. It's not child's play. if you're looking for an easy business, take up photography, modeling, something of that nature, it's cheaper. And you're not here to get even, you're here to get paid. So I'm going to isolate this week. Consider this as a Friday and this is a Saturday. A Saturday, Sunday gap on this period separator, and then this is our Monday here. Think about it. The price closed at a certain price point on Friday and it gaps down a couple of 100 handles. Okay? Since price is trading beneath that sell side liquidity, you're looking for price to go above the buy side liquidity. Okay, so this is number one, common sense, because on the previous week you were in your level 2, so you're now looking for your level 3 of an up market. So I'm going to now start speeding this thing up. Okay, they end the day back in a consolidation. I made the comments from the previous class that the markets will be moved from small consolidation ranges into bigger consolidation ranges. So it's going to consolidate on a smaller scale and then it's going to keep it out of that into a bigger range. So defining a bigger range of consolidation. That's what the market does. That's the entire business. The entire business is to keep you stunned and not ready for the next move. So you miss the trades. The business is not in you grabbing these trades. The business is in you losing the trades. The market maker is betting his capital on the fact that you will lose your trades 9 times out of 10. Okay? So on this day, price traded beneath the open. That's another way of looking at things. When price trades beneath the open, you can look for a buy trade because you know it's still in an uptrend. Swing high, candle that breaks the swing high, price retraces back into it and surely starts rising upwards simply because it has traded into this area in price. All right, so let me remove all annotations and show you what I'm speaking about. This area. Otherwise, this is a consolidation. That's the high of the consolidation. This is the low of the consolidation. To alleviate confusion, that's what I'm talking about. Right? So this is our W, our V, our V. What is the anticipation? You're looking for an M, which will in fact give you your A, and then probably your W to the bottom side. So, ladies and gentlemen, without wasting further without wasting further time or spending more of your time, I'd really love to answer your questions. See another reason to buy? They take out buy side, high of the consolidation. They come back and they take out sell side, low of the consolidation. Jesus, man. There it is. Your reason to sell. The marketplace now is finally here. The reason to sell the market is simply this. Consolidation, stop hands high. You're looking for a drop. So this is your secondary confluence to this. This is your first. If this is level 3, then I'm looking for level 1. That's point number 1. point number 2 is consolidation stop and high. So that's point number 2. Point number 3 is on this day, they gave me a consolidation to begin the day, and then they trade above that consolidation. Let me remove all annotations. The stuff is moving, so they trade above that consolidation. Them trading above that consolidation is a signal to me that price is in turn going to change its direction. And I'm going to start seeing a bearish market. So, ladies and gentlemen, I know this stuff is not simple. I know this stuff is most probably not going to make sense to the many of you who are neophyte traders. I think the word neophyte means beginner. Let us check this out. I always use the word and I don't even know the meaning of the word. This is your secondary reason to enter that sell when price trades above here. It might be your last reason or your last excuse to enter into that sell trade. Bang!
Oof. That's money right there.
A lot of money made.
Yes.
So why am I saying that this is your reason to sell? I sell on green candles.
Mm-hmm.
I'm going to say that again. I buy on red candles and I sell on green candles. Giving you some time to digest that right there. Ladies and gents, this is where I'm going to end. Right? This is absolutely where I'm going to end. Please ask the questions that you have. I'm going to go ahead, mute my mic, and I'm going to listen to the questions that you guys have.
So it looks like I know you're showing a pattern over the course of these 3 moves, which can happen over the course of a few days. Is that considered like a major move? Like I guess if you want to swing and hold longer, that would be one question. But the other one is, I also noticed that you can get those quicker moves within the consolidation, or like on the same day with the consolidation, the stop punt, and then you're getting in for the trend, right? So I'm kind of seeing it from 2 perspectives. Like, okay, your short-term trade is just looking for that consolidation stop punt and then get into the trend, and then more long-term or maybe bigger moves is looking for like the three legs that you're talking about, like over the course of however many days it may take.
Yes, well, you can swing
Right?
WVVM, and yes, you can scalp or spot trade the M's and the W's on the minute 15 time frame. Is there another question? Did I answer your question?
Yeah, perfect. Anyone else? Dr. Wallace, you got any questions?
Meanwhile, while we wait for the next question, with the swing trade, let's say you grab the W on Monday, no, the W. Usually or ideally, you can exit on the M on the Wednesday, 3 days later.
Okay.
This is the same for the M or the W pattern. Intraday, you can enter on the M. Your target can absolutely be the W. I know that I said my targets are usually the initial high or the initial low. But if your entry was at the high of the day, your target maximum can be the low of the day. And look at how price went beneath that low to grab the liquidity that was resting beneath that low, and it moves back into consolidation afterwards to begin the new day. Okay, so on this day, since this was my information, I'm not looking for buys, I'm looking for sell trades above this old high. Exactly. You're looking for sell trades above this old high here. When the moves are aggregated above here. Let me remove all annotations. I see the chat is growing. I'm absorbing it all. Excellent. Thank you very much, Dr. Wallace. I want to give you a thumbs up. So, okay, do I have any? Makes perfect sense. Thank you again, buddy. Alright, if we're not going to be having any more questions, can you do me a favor? I gave out homework the other day. If you didn't get the chance to be in the lesson from the previous Wednesday night, do me a favor, just do this for me. Go onto the charts of your choice, number one. Number two, mark out the end of day consolidation. But if you were not in the class from the previous day or from Wednesday, just go back to the Discord and watch the video. Okay, watch the video. When you watch the video, I'm also gonna post it on my YouTube at Cromwell Investments. Watch the video. I gave out the homework in that video. I'm gonna ask you guys again, just simply do this. Identify the consolidations. The consolidations are the entire business. You remember the market condition, consolidation, stop hunts, trend. When you're able to identify the consolidation, the stop hunts and the trend fall into place easily. Well, I hope you found this insightful. From me to you, thank you. To you guys, good night. To me, I'm hoping to have a great day.
Yes, have a great day. We appreciate you.
Thank you very
so
much. Thank you very much. Good night, guys.
Good night. Y'all good, everybody?